Good morning and welcome to this Monday, December 6th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, kind of got mixed futures so far this morning to kick off the week. Right now, just looking at the diamonds to track, which tracks the Dow Jones. We got the diamonds up almost 0.75%. So it looks like we'll get off to a decent start, little recovery on the Dow Jones. We got the spider, the SPY, tracking the S&P 500 up a little less than 0.5%. And then the QQQ, which tracks the NASDAQ 100, it's down about 5/100ths. So not really a whole lot. It was down further this morning, so it has come back a little bit here as we prepare for the market open. Of course, it was a really rough week last week. You might not look at the S&P 500 or the Dow Jones and think that it was that bad of a week, but anybody who was in growth stocks, especially small cap growth stocks, it was a completely different story. A lot of selling. We're going to talk about some of that today. Let me go ahead first before we get this thing going and just kind of welcome all of you, but especially some of those who may be new to Earnings Beats. I want to welcome you all in here today and just tell you briefly a little bit about us and what you can do if you want to follow along with some of the things that we do at Earnings Beats. We do, of course, have a paid service, which you're welcome to come in. It's a 30-day no-cost trial, but that one does require a credit card just so we can get you set up in our system. But if you scroll down, if you are new and you just want to kind of learn a little bit more about us, we have a free Earnings Beats Digest newsletter, no credit card required. You can unsubscribe at any time. We publish that Mondays, Wednesdays, and Fridays. All you need is your name, email address. Hit that subscribe button. We'll get you set up, get started. Normally, these are, it's normally pretty brief read, just a couple of paragraphs and a chart featuring things like relative strength, earnings, companies that have come out with strong earnings. A lot of times there's a gap related move that we like to look at. We do a lot with gaps, but just check it out. Again, just go to earningsbeats.com, scroll down, and you can find these couple of boxes here. Put in your name, email address, hit that subscribe button and get going. We'd love to have you. Let's go ahead and talk a little bit about what happened last week, because it was not a good week for the markets. I mean, technically, we saw some damage on the charts. As far as I'm concerned, it's short-term damage. It's not long-term damage, and I don't even believe it's intermediate-term damage, but it is some damage. We're not, we haven't been used to seeing a whole lot of selling for about the last 20 months or so. And we had some warning signs, and I'll talk about that a little bit later as well. But we have seen now some selling. You can see the Dow Jones Industrial Average, which lost 60 points on Friday, is down into a range where we've seen some support recently. So I think we start moving more into like an intermediate term issue if you fail to hold intermediate term support. So the 33.4 to 34,000 area right in here, I think is just a good area of support where I would expect to see the Dow turn back to the upside. The S&P 500, I mean, we don't really have any major support until we get down to 4,300. We did break out above about 45.30, came down on Friday, and we're right about that level, closing at 45.38 on Friday, and that was down 39 points. So I think we got a little bit of short-term battle maybe taking place here on the S&P. The NASDAQ, clearly the worst performer of the three last week, lost 2% on Friday, or almost 2%, 295 points. We did close at 15,085, which is not only now below the 20-day, but is also below the 50-day. So definitely in the short term, that's not the kind of configuration we want to see. But we've got an uptrend in play, higher highs, higher lows. So I think this is going to be the more critical intermediate term low, which is all the way down at about 14.2. I know that sounds like, that'd be horrible, but we literally went up from 14.2 to 16 in maybe 5 or maybe 6 weeks, maybe even 7 weeks. I don't know. But when the selling hits, selling happens much faster than the buying. It's just the way the market works. I call it, when you go into one of these more volatile periods, I call it market makers going on vacation, because when you look at price action, you get stocks that took, maybe 6, 8, 10 weeks to go up, quite a bit. and then literally in about 3 or 4 days, they give it all back. Because there's no buyers in terms of market makers. I don't know what the percentage is of market makers transactions. That would be an interesting question for somebody in the know. I don't know, market makers trading on their own account, how much that impacts the market, but I have a feeling it's quite a bit. And so when they stop trading, when things get volatile, I mean, just think about it. Let's say you're a market maker and everybody wants to sell, and your job is to provide liquidity, and you have to buy stocks to provide that cushion, if you will, in the market. When you see the volatility picking up and you see the volume to the downside accelerating, probably the last thing you want to do is throw your money in there to try and, break that fall. And so market makers, the prices just go down. And the thing is, when we see the volatile action that we've been seeing, I always say it all comes down to sentiment indicators. You can throw your technical charts and stuff, maybe not out the window, but I would be careful about trading too many stocks and saying, oh, it's a key support here, let's just jump all in. When you get the volatility index up into the 30s and you get the equity only put call ratio starting to move higher, those things are telling us that we're in a little bit more of a panicked market. And so rationale goes out the window, or rational behavior, I should say, goes out the window. And you get instead very rapidly falling prices. And it seems like, what happened? Well, we don't have any market makers around buying stocks. That's what's happened. And they wait until basically the kitchen sink gets thrown in. And then they go in and buy everything they can. And that's how we form what I consider to be major bottoms. So I think we're in that process right now. But the problem is, if you're off by a day or two, or maybe even a week, it could get really expensive. We've got a couple of big reports coming up, inflation related. Our first one will be up, I believe it's this Friday. It's the 10th. So today's the 6th. Yeah, it'll be Friday. And I think that's the CPI. And then the 14th, which will be Tuesday, we get the PPI. Now we'll go through and talk about how the market's been shaping up, but there's obviously been a lot of talk about inflation. Well, we're going to find out. We're going to get some more news coming up at the end of this week. And while I'm going to follow the charts to really figure out whether or not inflation is a problem, in my opinion, it's still the headline news that can drive the market, especially if if the market's already in a bad mood. So anyway, just looking across here, you can see the damage. Here's the mid caps getting hit pretty hard, down 1.25%, small caps down more than 1.3%. But across the board, you can see those intermediate term lows have not been taken out. So short term, yeah, we're in a downtrend. We're below the 20. The 20's trying on the small caps anyway to cross back below the 50. So this type of configuration in the short term, it's not giving us any signs yet that selling's over. And that's what we need to really focus on this week. But to the downside, we're still holding these key intermediate term support levels. So short term weak, intermediate term, I think we're still bullish. Long term, unquestionably in a secular bull market. All right, staples were the leader. So you got defensive groups leading. That's normal when you're seeing selling. I get a lot of questions on this. Well, you said whenever defensive stocks lead, that's bad for the market. Well, when the market's going down, defensive stocks always lead. What makes me more nervous is when the market's going up and defensive groups are leading. So staples leading, utilities second, healthcare third, three of the defensive groups. And then down at the bottom, the aggressive groups, discretionary, technology. That's where you're going to find a lot of those growth stocks. Still looks pretty good on the AD line on the XLK. The XLY not quite as strong. I mean, overall, we're just looking at the last 6 months. Overall, there's definitely a longer term uptrend in play. But in the short term, you can see we're definitely moving lower, setting some new lows on that AD line on the XLY. So again, short term, we've definitely got issues. And with the volatility picking up, can we, which support level should we count on? That's a great question. I'm not going to be going all in just because a stock or an index is hitting support, not in this kind of an environment. I really want to see big reversals in the VIX, see the put call ratio, maybe print some kind of a panicked level. We started to see that on Friday. Those are some of the things I'm going to be looking at. I tend to turn my attention in this kind of a market away from technicals and more towards sentiment. All right, 10-year Treasury yield. So today, economic reports, really nothing out of significance. So the market's just kind of left the trade off its technicals and all the headline news, and it's a Monday. So you put all that together, and probably not the best scenario. I mean, maybe we'll get this bounce. We certainly are in need of one. It's been going down quite a bit. The 10-year Treasury yield, though, is going down. You would think, I would think anyway, that growth stocks would be holding up better than they are. I mean, we are seeing some like large cap, the Apples holding up fairly well, but a lot of the small caps are not. And, one of the things that kind of got this move to the downside started was, well, maybe not started, but really accelerated, was DocuSign. When they came out with their earnings last week, their earnings actually beat. Sometimes people, you're as a trader or an investor, you scratch your head. You're like, wow, they beat their earnings estimate. They, their guidance was not good. And what happens with many of these growth stocks is that once you lower your guidance, it's not just a one-time thing. It really has this trickle effect if you do valuations, because now all these future earnings, all the future growth, that you can't count on it anymore. I mean, now management's lowering guidance. So that's what happens. It's that cascading effect in these growth stocks because they're not valued based on their balance sheet. So there's nothing on their balance sheet that's going to hold these stocks up when they start lowering guidance. And that's the risky part of being in growth stocks, is that growth is what's driving the valuation, that future growth. So anytime a company lowers its guidance and you start seeing breakdowns on a technical basis, it's a reason to kind of pause. So a stock like DocuSign, even though, after 45% drop or whatever it was on Friday, you think, well, boy, this is a great price. I would just caution you, because you look at a stock like Zoom, and I don't have these charts up, by the way, just kind of talking in theory right now. But with a stock like Zoom, once Wall Street started talking about slowing growth, it wasn't a one-day thing or a one-week thing. It's been a lengthy thing. Now, I think it's overshooting on Zoom, and I think it's overshooting on a lot of these growth stocks. But I'm not the one that makes the prices go up and down. I mean, there's obviously lots of folks that are buying and selling, but just remember the market always tends to overshoot in both directions. So I think right now a lot of that's getting overblown. But looking at the 10-year Treasury yield, you can see with the yields coming down, one of the big factors of valuing growth companies is interest rates. And we saw what happened to growth stocks when interest rates were going up. Remember that February to May period? Growth stocks got crushed, but yields were rising. Last week, we saw growth stocks going down while yields were falling. And that's the part I'm kind of, pouring through a lot of charts, trying to figure out what's going on, because I don't listen to the media. I think those of you who've been listening to the show know that's not where I try to get my news on what's going on in the market. They're just looking to get clicks. So it's just headlines. It's, it's the train wreck that they're trying to portray, whatever, to get the clicks. But you can see the stories by looking at the charts. And when I saw that last week, the 10-year Treasury yield dropping like this and growth stocks also dropping, it's definitely a risk-off environment for sure. Is it short-term or is it long-term? I believe it's short-term, but falling yields, the other side of this is rising Treasury prices. That's why the yields fall, because everybody's buying Treasuries. So Treasuries, another way to look at it is look at the TLT. So here's the other side of the yield. So here you've got the TLT breaking out above these tops, and then you got the TNX. Actually, let me just back up here. And then you got the TNX coming back down and breaking below these lows right here, and even this support area. So it's just a flip. So when you see the yields going down, it just means money is rotating into bonds. And when money's rotating into bonds, it's telling you the market's more defensive. But normally when the market's even if the market's defensive in a growth environment, the lower interest rates normally benefit growth stocks. And that was not the case last week. And I have some other charts I'll show you in just a bit on that. Well, let's keep moving on. I want to show you, this is another chart. This is the 10-year Treasury yield, but down here, I've got in different panels, I've got the QQQ versus the S&P 500. It was holding up pretty well until Friday. The reason? Well, one of the big reasons, Apple. I mean, Apple's the largest holding. Apple's a much bigger holding in the QQQ than it is in the Spider. Also, we've seen recently, I mean, XLY and XLK for the most part have been doing pretty well on a relative basis, and that's been driving the QQQ over the SPY. The IWF, IWD, the IWF, this is mostly large cap stocks, and this does have a lot of Apple in it. The IWD is more diversified among a lot of the larger cap names. So it's more, I think of this, I look at this, I say large cap versus, large cap growth versus large cap value. Then the final one down here is small cap growth versus small cap value. And so when you're looking at these charts and I see this going down and I'm watching the QQQ go down on a relative basis, and now I'm seeing the IWF roll over, and growth stocks have been underperforming anyway. And now growth stocks, small cap growth stocks versus value, looking to move to about a 6-month relative low, 5 or 6 months. Not quite there, but getting close. So this is the area of the market that, in my opinion, is getting hit the hardest. And we're seeing a lot of these small cap stocks, small cap technology, small cap discretionary. Many of these companies are the ones getting hit the hardest over the last week to 10 days. All right, moving on. I wanted to go back and talk a little bit about some of these articles that I've written. If you don't follow my articles over at Trading Places, hopefully you should. I try to learn about the market over the years. I have learned a lot. I've paid a lot of market tuition, and but every time, I try to learn something, whether I'm making money or losing money, but especially when I'm losing money, try to figure out, what I did wrong or what I could, take away from this selling episode, maybe to help in the next one, anything to try to gain a little bit of an advantage. And so there are certain things that I look for in the market that make me nervous. Even, if you've been following me, I've been very bullish, and I'm still bullish. I mean, short term, yeah, it's bearish, no doubt about it. We're selling off, volatility is, increasing. You always have to be careful when the VIX is on an uptrend. But this was written November 16th before all this began. And, I try to look for any kind of clue that we could be in for a rough period. And even if we're not in for a rough period, I just want to be aware when the risks are increasing. Again, market could keep going higher, but it's not the same kind of a risk environment every day. It's different. It's, different weeks, different months are just set up differently. And so when I wrote this article, of course, we had options expiring. That was part of it. But there were a couple of other issues that we had. One, you can see here on the S&P 500, if we broke out again, we were likely to set a negative divergence. And that was right when we were around 4,700. Now, I don't know. Well, you can always look at these charts. Look at what happened. We went up and we failed. We went up one more time after I wrote that article, failed, and then came back down. And then what we look for is centerline test and a 50-day test. Well, look what happened. I mean, and this is something I picked up a long, long time ago, looking at negative divergences and just finding out that, when the PPO is rising at the highs, normally pullbacks are held by the 20-day. But when you go back up again and the momentum is turning and heading back in the other direction, many times those breakouts or false breakouts are this kind of the signal. If you get a reversing candle, a lot of times that's when you really want to be careful in the market with a negative divergence and a reversing candle. We got that, and you can see what's happened since. So the signal there, I think, was pretty solid signal. Now you go down one more, and then we started to talk about this major sentiment issue. One of the things that I look at in the market is the volatility index. To me, that's probably the most important sentiment indicator. And all the volatility index is doing is it's looking short term at certain S&P options, and it's looking at the premium that you pay on those options. And as the premium goes up, the market is anticipating or pricing in more volatility ahead. That's what the VIX is doing. So when you start seeing the VIX moving up And we almost always see the VIX move up. You can see here, this was March of 2020. So the VIX went skyrocketing. Of course, we had a pandemic. The end of the fourth quarter, 2018, this was the trade war right here. In May of 2019, we had another little episode with the trade war. We got this pop. I mean, I don't remember everything that happened with each one of these spikes. But my point is that when the market sells off, the VIX goes up. That's normal. When the market goes up, the VIX goes down. That's normal. So as the market goes up, it gets more complacent. So the expected volatility going forward is not going to be that great. Premiums will come down on options and the VIX will come down as the prices go up in the S&P. When prices go down in the S&P, people start getting more nervous. The volatility spikes because now the expected volatility, the expected moves start to become much greater. So the premiums on options become more, it's more expensive to buy options because we could see much more, much greater volatility. So all of that we know, or we should know. But what really starts to kind of get the hair up on the back of my neck from a trading standpoint is when the stock market is going up. Here's the S&P 500 going up, but the VIX was going up. And the correlation between the VIX and the S&P, I just talked about how it should be inverted. It should be a negative correlation, and it usually is. In fact, it's normally down really close to -1, which tells us it's almost perfect inverse correlation. But there are periods when the market starts to get nervous. You don't see it in the S&P 500. The S&P 500 is going up, up, up. CNBC's having a little party. Everything's great. But the VIX is telling us that the market's getting more nervous. And the VIX is telling us that the S&P 500, the options are beginning to price in more volatility ahead. Well, more volatility normally means lower prices. So it's just weird. And you can see this is the last 3 years. This doesn't happen often. 1, 2, 3, 4, 5, 6, 7 times in 3 years. And that's actually quite a bit. But 7 times in 3 years, we've seen the correlation with the volatility index in the S&P 500 pierce that zero line and go positive. This is the S&P 500. So this is what happens after we get those peaks. There you can see May of 2019, that was that trade war. So the volatility index was warning us that the market was growing more nervous, whether it was trade war or whatever it was. The way I look at it is when I see that, I feel like the market is getting nervous and won't handle bad news as well. Sometimes you talk about the stock market climbing the wall of worry. You've probably heard that Wall Street adage. Well, in this case, yeah, the Wall Street's going higher, S&P 500 is going higher, but it's starting to tell us, it's giving us a signal that we might not be able to climb this wall for much longer. If the worries keep coming in, it's probably going to take its toll. So there was the decline in May. Now, May of 2019. Now, what happened? We went right back up afterwards. Here, we started to get the signal about a month, a little over a month before the pandemic set in. Now, of course, the pandemic, yeah, we're going to definitely have fear over a 100-year pandemic. There's no doubt about that. But I mean, this wasn't a great signal. The timing, it was close, but it wasn't perfect. We did have a little bit of a pullback before we had one more move lower. But look at September 2020. I went back and I actually wrote an article. It was on September 3rd of 2020, writing about this very same thing, about the VIX. And there may have been issues with the put-call ratio. I don't recall. I'd have to go back and look at that article and see what else was going on. But look at what happened after that. That month, September, was horrible. It took us until November to make that breakout again. So it was a couple months later. But we did make the breakout. We did go higher. Here, this was the one signal I would say really didn't pan out very well. I mean, if you got cautious, went to cash, you probably ended up buying some things back a little bit more expensive because we just never really saw a bunch of selling. Here, almost right after we peaked, you can see selling came in. And now here, this was back when I wrote the article. So you can kind of look, we were at 46, almost 4,700. But now let's click on this chart and see what it looks like. Now look at what the S&P 500's done. So, this is just one of those charts that you're not going to hear anything about on CNBC. You're just not. Nobody talks about this. And I, as I said, I'm normally pretty bullish. I'm pretty optimistic about the market in general, because the market goes up more than it goes down. I see some who are just always pessimistic, and I'm like, how is that working out for you? I don't know how anyone could just be pessimistic about the market all the time. The market goes up. I think it's gone up like 70% of all the years since 1950, maybe 80, might be over 80%. I forget the number. I don't understand. I mean, yeah, there are times you definitely want to be bearish, or, certainly more cautious, but to just constantly be thinking the market can't go higher. And there are plenty of them out there. They don't, when it's going down, they say, okay, here we go. And then it starts going back up, and they start immediately again saying, well, it shouldn't be going up. My philosophy is market goes up a lot more than it goes down. So I'm going to be bullish until the charts tell me that I need to be bearish. So anyhow, that was a pretty interesting and timely article, I thought. But there are definitely other signs that we can look for as well. Clearly just the technical breakdowns and so forth. I mean, those are easy to see on the charts, but, kind of seeing the clouds on the horizon before it starts raining is really important. So a couple of articles I wrote over the weekend, I'm just going to briefly show you. I mean, this is how fast some of these stocks can go down. There's Tesla getting hit. So there was a Tesla chart. Facebook, I mean, since the 22nd of November, 352 down to 300, down more than $50. Here was Etsy, which literally over the last week was at an all-time high and lost $80. That's how quickly these charts can change when growth goes out of favor. And then I talked more about the sentiment and where we need to be looking. Here's the VIX. And that's really the big takeaway for me, is that many bottoms in the stock market form with the VIX going up into the 30s. Now, is the market going to bottom with the VIX at 30? Is it going to be 35? Is it going to be 37? Is it going to tip, get into the 40s maybe? That does happen when things really get panicky. Well, if you think it's 30 and it turns out to be 40, you're going to find prices are much, much lower on those next 10 VIX points. So there's no way that you cannot have risk right now. You cannot avoid risk. So sometimes if you want to get in the market, I suggest, maybe thinking if you're in cash or you've moved to more cash and you want to get back in, I'd think about maybe something like the Spider, or the QQQ, so that you're not putting it into one or two stocks, but rather putting it into a basket. Because if we keep going down, the QQQ probably is not going to get hit as hard as many of its component stocks, because that gives you the basket of stocks as opposed to one or two. So that's just one way to consider it, when things are really spicy. The other thing here, this is the equity only put call ratio. Friday's reading was the highest we've seen in a year. That was a 52-week high. In other words, everyone is now in the options world starting to pour into the options. And so this was the daily chart of the equity only put call ratio. Here's a 5-day moving average. So it's smoothed out a little bit. But look at these moves when we've gotten in the last year, when we've had our 5-day moving average move up into the 0.55 to 0.60 range right in here. These green arrows, look at what's happened in the stock market. Bottom, not really a whole lot, but we didn't go down any. Little short-term bottom there. Here's a bottom, and now this is where we are. So this is starting to paint us a picture that I don't know if we're at a bottom, but it's saying that we're getting closer and closer to a bottom. Doesn't mean we can't have another couple of days, and it doesn't mean this can't be a little bit worse episode than what we've seen recently. But I believe the sentiment issues are the sentiment readings starting to tell us we're getting close. And then the other one I wrote in the Chart Watchers this weekend was talking about valuations, talking a little bit about my background in public accounting and how you value companies and the effect that things have on growth stocks and blah, blah, blah. So you might want to check that out, but we're running out of time. I did want to just point out this DocuSign chart. Here was that gap down. I would have expected actually after that huge gap down for us to at least recover a little bit, and we didn't, which to me is a very bearish sign for DocuSign. I think the opening, when we opened there, I was thinking, well, maybe we can get back up to 180, which was a prior low. Now, after this kind of move down on this volume, I think the open, which was at 154.80, I think that kind of becomes the short-term ceiling now on DocuSign. So any kind of a move back up to test that gap resistance right there would probably be an out for anyone caught in that earnings move to the downside. Let's move on to, I want to go through and talk a little bit about the three you must see. Let's wrap this thing up. There really isn't much out in the way of earnings, by the way. So the three you must see, this was just another example. This is CyberArk Software, a company that looked like it was just fine. Volume trends were good. Had the double top at 200, and literally over the last 10 days or so, we've lost 25% of the value. That's bear market territory. Many stocks have moved into bear market territory. Etsy that I showed you went from 300 down to in the 220s. That's bear market territory. Doesn't mean that they're going to, go down and into oblivion. I'm just saying 20% is, if every stock did that, we'd be in a cyclical bear market. So these growth stocks, that's just giving you an idea of the extent that some of the growth stocks, the beating that they've taken. But anyway, this is CyberArk getting hit. I wanted to show you a couple other charts here. One is ZTO. So here's a big gap up. Look at that big heavy volume right there, 17, 18 million. Reversed, came all the way back down the low. When I get a black candle like that, a big reversal in volume, it tells me that the odds of going back to fill this gap are much greater than if this had been a big hollow candle. And sure enough, that's where we went. We went down and filled that gap on Friday. So I just wanted to point that out. JD is the last one, trying to hang on to a support level right here. Long tail below on Friday, but now today gapping down below it. Looks like we're probably heading back down to around the 69.70 area. All right, that's it. We have run out of time. The market is now a couple minutes in. The Dow having a good day, but you can see again that the move is away from the growth stocks. NASDAQ down a little bit, not down a lot, but if the selling were to pick up, I think this is probably the area where we would continue to see that sell off. And you got to be careful in the mornings anyway. Sometimes you get the big sell off on a day like we had on Friday, get a little bit of a bounce, and then the selling resumes. Be careful if that low from Friday is taken out, because I think that could trigger some more panic selling. We really need one of those big lines moves to the downside intraday and a big recovery in the afternoon. That to me is a sign market makers have kind of come back on the scene. So until we get that, I'd still be a little bit nervous. Most bottoms don't just go down and finish at a low and the next day you just start going higher. Normally you have another low and trigger more selling. So I'd be a little nervous about this move to the upside in the near term. All right, that is it for me. Just want to wish everybody a good day, and hopefully see this market turn around this week and finish off better than we start. But have a good day. I'll be back over at Stock Charts TV for your next episode of Trading Places Live. Have a great day, everybody. Happy trading.